Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London, UK feed wheat. Paris milling wheat. I have a singular big picture item here on this daily chart which I've had for a long while, and it's actually over 2 years old. It is the big June/October originating and running through to April 2024 bear channel. Currently 202 for the upper bear channel line to well off the bottom of my daily chart for the lower bear channel line. This bear channel is still highlighted in dark blue on my daily chart and has been only since mid-April this year that we saw it broken on the upside. Yet even now it is still so significant that I've decided to keep it not only highlighted but also still on my daily chart. So on the 22nd of April, prices punched up through this dark blue highlighted upper bear channel line and moved higher up to arguably the most difficult overhead congestion between 267 to 270, where the market was capped at the end of May. In the process of moving higher, the market created a very steep and acute late April to late May bull channel, highlighted in purple on my daily chart. So before I deal with this bull channel, let's go back a bit to that break of that big old bear channel. The break high gave a primary target X for the move up in the 277 area, for secondary high to reach target X1 up in the 312 area, which is up off the top of my daily chart right now. So what stopped it rising and turned the market into a V-top? Well, it was that 267 to 270 resistance area. And now draw your attention to the exit out of the purple highlighted bull channel into a new pattern, pink highlighted June base, quite acute bear channel. The move lower has been as dramatic as the rise. I spoke on this 4 weeks ago where I said, and I quote, how this, and I quote, gives some new opportunities on the downside without ruling out the larger, longer term potentials on the upside. You could call this a possible diversion, if you will. Thus, we have a potential primary target X2 down in the 244 zone and a secondary and harder to reach target X3 down in the 233 zone. In theory, even dropping down to target X3 at 233 would still keep targets X and X1 above still alive. But I imagine we might have developed some newer patterns by then, should prices venture that far. End of quote. 2 Fridays ago, prices reached the primary target X2 at 244, and last Friday the market reached the secondary target X3 at 233. The key levels to where we are now is the congestion at 227, the flatlining gold highlighted long moving average currently 228, slowly rising medium moving average currently 226, the bright red neckline extension, the June to November 2023 head and shoulders top, and the overhead congestion between 238 to 242 containing the March 2013 high at 240. Of all of these, the two most important are the bright red neckline extension and the gold highlighted long moving average. However, I should also point out, as I said last week, that, and I quote, an obvious area of support is further below, starting at the 50% absolute Fibonacci line at 219, and mainly centers around the old descending triangle and bullish halfway hesitation from April between about 213 up to the 50% absolute Fibonacci line. However, I only point this as an obvious spot, not necessarily a strong support. For that, well, you would have to go down to the original feature that started this whole late April to date action, and that is the dark blue upper bear channel line, currently at 202. End of quote. The market has for the moment stopped short of going all the way down to the dark blue channel line, and I suspect it is for this reason. V-tops, such as this one here, sometimes form a handle or sideways action, usually a pennant or a bear flag on the way lower. Sometimes, and this is very rare, they form a flat rectangle. The issue is that a handle is a hesitation in an otherwise continuous move lower. But a rectangle, well, that is the end of that pattern, or in other words, the end of the March to date action. The next few weeks will define which course the market chooses. Minneapolis wheat. Now, my apologies for some of the labels being highlighted in bright red on my daily chart. Sometimes my charting system throws a wobble and does this sort of thing unintentionally. So please note there is no special meaning in any of the labels being highlighted in bright red. Back in late February 2023, and especially at the start of April last year, so that's now outside the parameters of my daily chart, the the market constructed a large bear channel that morphed into what is now highlighted in dark blue on my daily chart, a descending, expanding wedge pattern, currently 710 to down well off the bottom of my daily chart. The upper trend line is currently escorted and reinforced, and has been for some time, though not very well recently I have to say, by the declining long moving average currently at 706. Now going back a bit to early December last year, the short medium moving average currently at 693 started capping prices. In truth, this moving average had been an effective cap of the market since mid-October 2023, not tested but effective nonetheless. However, on the 22nd of April, after some base building since late February, the market broke higher, over the short medium moving average as well as over the medium moving average currently at 678, and some other significant resistances in the band between 693 up to 708. In this band we also have two other patterns I'd spotted earlier nestling like Russian dolls, one within another. 34 weeks ago I said the following of the first pattern highlighted in purple on my daily chart, and I quote, "It is the nascent late August to date bear channel, currently 658 off the bottom of my daily chart." Once again I note how we have a smaller bear pattern nestled within a much larger one, much like a Russian doll, end of quote. The second pattern is no longer highlighted and is the October 2023 to late April bear channel, currently 563 to 667. This pattern had seen some market touches and likewise was also broken. Prices 5 weeks ago exited up and out of the 693-708 congestion band, creating a steep, acute and ultimately short-lived late April, early June bull channel, highlighted in bright red on my daily chart. This original break higher gave me the opportunity to consider potentials topside, and by potentials I meant there were multiple targets topside. Some were reached and some were not. Of all those targets, only the primary target in the 777 area for the purple highlighted bear channel and the primary and secondary targets for the unhighlighted bear channel had been reached. So what were the obstacles that prevented the market reaching all those targets? First off was the capping of the market 4 weeks ago by the July 2021 low at 778. Initially it didn't look that aggressive, but this resistance stopped the rise and turned the market lower, back down within the dark blue descending wedge pattern, back below the long moving average and down through so many supports that are now resistances. The move lower was enough to create a feature I noted 2 weeks ago, a June based, very narrow, very acute bear channel highlighted in bright pink on my daily chart. What has been surprising is how prices had sliced down through and the congestion formed over February to April between roughly 635 to 676, as if it wasn't even there. The market dropped down to the October 2018 high at 611 and the April 2021 low at 606, and perhaps most interestingly, the green highlighted September 2019 to date uptrend, currently 598. Not tested but down there, where this week from Tuesday through to Thursday inclusive, the market has tried to form a 3-day bullish morning doji star pattern. This last level, the green uptrend, is perhaps the best looking of all these three and the most crucial. You see, below this green uptrend we really don't have that much support until the December 2021 low at 542. And it also ties in with what ultimately is likely to be the big picture pattern here created since February. So for about 5 months, and that is the whole of the action, is an inverted diving board pattern, a pattern that I have been seeing duplicated in some of the other grain markets, but one that has not been as advanced as it's seen here. I suspect that much like many times in the past, Minneapolis week today has been a leader showing what eventually will happen in the other grain markets. The choice now is very simple. Is this as part of a V-top, even though it's still part of a bigger diving board pattern? Is part of a V-top, is the action this week a hesitation, such as a bear flag or a pennant? Or is it the beginning of a sideways rectangle or sideways pattern of some form? If it's the former, just a hesitation, then we have a big move further on downwards. If it's not, we have a hesitation, then the whole action from February to now, that's finished. That's the end of that pattern. We are on to something new. And the next week or so is going to determine that whole operation. London UK feed wheat. The extension of the neckline of the May to June 2023 reverse head and shoulders bottom, which is currently at 193.15, helped cap prices in May, along with the August 2021 high at 199.20 and the March 2013 high at 205.05. Together they created a V-top pattern with a very sharp downtrend slope that, if you include the ascending triangle pattern over late March and the whole of April, becomes an inverted diving board pattern. The second part of this pattern and of the V-top was the very late May to late June bright red, very acute and narrow bear channel. This bear channel overcame all the congestions in the way except this week, when congestion at 164.95, just above the combined lows of July 2021 and May 2023 at 164 even, when this congestion caused the market to exit out of the bright red bear channel. I should mention that we also had congestion nearby from March to April 2019 between 161.95 to 165.75, but I'm not sure how much of a part these played here. Anyway, what we are looking at now, well, this market has two options. The first is to form a small bearish pattern, such as a pennant or a bear flag, over the next few weeks. This ties in with the V-top patterns, as they sometimes have such patterns during a move down. They effectively act as a catch your breath moment before resuming the move lower. The alternative, and rare alternative, is to see the market form a full handle, such as a sideways rectangle, in which case the current V-top stroke inverted board, diving board pattern dating from March this year is over, and we move on to something else. Watch carefully to see which the market chooses. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.